Okay, so what I'm going to do, I'm going to put up on the screen the answers from the question from yesterday. This was actually from a CXC specimen paper. So I have the full answers for you, and we're going to finish the new topic. Okay, so there we go. So the first question, they ask you for 2 accounting software programs used for payroll. So any 2 answers from here you could have used. So we have QuickBooks, and I spoke to you all about QuickBooks already. That's the program that I offer at CTS. Peachtree is another program. Sage, well, Sage 50 is what is now being used. It is actually Peachtree, renamed Sage 50. And of course, there's Microsoft Excel. So the regular Microsoft Excel, you can use that for accounting as well. And there's Accountant Edge. I'm not familiar with the Accountant Edge. Okay, so only 2 of these you needed to put in your answer. So you can take them all, but of course, learn off 2 to 3 of the ones that will be easiest for you to remember. So you can go ahead and take down your answers. For part B of the question, they ask for 2 differences between statutory deductions and voluntary deductions. A statutory deduction is a deduction that is required by law, which means you do not have a choice in whether you make the payment or not. So it is a must. Okay, statutory deductions required by law. So examples would be income tax, national insurance, so like NIS, health surcharge. A voluntary deduction, however, would be a deduction made by the employee's request. So a voluntary deduction, the employee can start it at any time and they can stop it at any time. It is up to them. So some examples of it will be trade union dues. So if they have to pay a fee to the trade union, if they're making payments to a group health or pension plan, personal insurance payments, if they are making any contributions to a social fund or credit union payments. So sometimes they might have to pay, maybe they take a loan from a particular organization, and the organization will ask them to set up the payments to be deducted straight from their employer. So that will be considered a voluntary deduction. So it is up to them to set it up, and the employer every month, if they are paid monthly, every month that money would be deducted from their salary before it even goes to them and be sent to the person they have to pay. So the main thing here to remember is that a statutory deduction is required by law. A voluntary deduction is made at the employee's request. Okay, and we have the examples. So you can go ahead and take down the relevant answer. Okay, so I'm moving forward now to the next question. Hmm. Okay, 4 main sections of a business plan, and you would have gotten this straight from your handout. So some of the sections we have executive summary, which is where they summarize the entire business plan, the background of the company, operations plan, marketing plan, financial plan, and marketing analysis. Now, here they ask you for just the main section. So you're just naming the 4 main sections, but they can also ask you for a definition of the sections as well. So I would suggest you go to your handout from yesterday and you include a little definition with it as well. I'm going to also go to this question one time, part E. List 3 essentials of a cooperative. A cooperative is where you have a group coming together to do something that is in the best interest of their members. So a cooperative is owned by the actual members who are part of it. They have a board of directors that they elect, the members will elect to manage the cooperative. They do not pay taxes. The members will buy shares in the business, which means that they will invest money into the business to own shares or part of the business. Usually, cooperatives will be set up to do some sort of or to provide some sort of benefit to the members. So they say here provide goods or services. So what they could do actually, so a typical cooperative could be like a consumer cooperative where the members will come together, pool their money, and purchase goods in bulk. When you buy goods in bulk, you are able to get it at a cheaper price. And when they buy the goods in bulk, the members will benefit from that. Whereas if they go and buy it on their own individually, they will obviously pay more. The goal is not to make a profit. The goal of a cooperative is to work in the best interest of the members and provide something of benefit for the members. So profit is not the main goal. If, however, they do turn over a profit, that profit is divided among the members, which are basically the owners of the cooperative. All the members, they will divide it among all of them and share it with them. So this is a very good list for you all to take down. It summarizes cooperative nicely. So go ahead and write down this list here for part D and for part E. And then we'll go to finish off your handout on business plans. You all can let me know when you are finished taking these things down so I can continue. Are we finished? Or am I rushing you? Okay, Newton, finished. Musa, are you with us? Okay, so I'll take no response as my response. Okay, let's continue. So what I want to do is go back to the handout we were looking at yesterday, accounting for the entrepreneur. Okay, so we are looking at budgets now. Sales budget, first of all. So the sales budget contains an itemization of a company's sales expectations for the budget period in both units and dollars, meaning they're basically planning for how many units of goods that they will need. Companies need to do this to obviously make sure that they don't run out of stock, one, and secondly, so that they don't over invest in stock, because that money that they invest into stock could be used for another purpose. So that is why they need to work with a budget. Of course, their budget cannot be exact. They would need to have a little bit extra. So if we look at the actual budget here, ABC Company sales budget for the period ending March 31st, 2018. It is laid out like this. So we have the months, January, February, March. We have basically your details here. The first line, we have forecasted unit sales, meaning they plan in January to sell 5,500. They plan to sell 6,000 in February, and they plan to sell 7,000 in March. The price per unit, meaning one item will cost $10. January, February, and March, though, it goes up to $11. So that is how much one will cost. So obviously, to get your total gross sales, we are multiplying the forecasted unit sales by your price per unit. So 5,500 by $10 will give you a total gross sales of 55,000. February, 6,000 by $10 will give you 60,000, and March, 7,000 by $11 will give you 77,000. The sales discount or allowances, so that's like, yeah, we have a certain amount of sales, but sometimes we might give our customers discounts, or we might allow them little bit something off, give them an extra unit or extra 5 units. So we have to take that away from the actual sales figure, right? So that's like discounts allowed. So in January, we had $1,100 was discounts. We have to minus that from our total gross sales, which means the net sales that we actually did for January would have been 53,900. In February, our discounts 1,200. So we take that away from our gross sales to give you the net sales of 58,500. And in March, allowances of 15,040, we take it away. Question? Hi Musa, welcome back. So we are now looking at the sales budget, okay? So I'm going through the sales budget here. Now this is actually a very simple budget, but the same basic principles will go throughout. So if it is you're doing accounting at a higher level, basically this is the budget that you're working with, right? So I was on March, I was saying sales discounts, $1,540. the discount has to be minus from the total gross sales to give you your net sales of 75,460. This is our budget for the period. When we know our budget, meaning how many units we are planning to sell, we can use this and help us come up with our production budget. The production budget now calculates the number of units of products that must be manufactured. So if we know we're planning to sell a certain amount, obviously means from that we have to plan how much we are making. And it is derived from a combination of the sales forecast and the planned amount of finished goods inventory, meaning how many items you're going to have in your inventory or in your stock at the end of the period. And usually as safety stock to cover unexpected increases in demand. So as I said, if you estimate you're going to sell 5,500, you cannot only produce 5,500, because let's say for some reason, so like currently, people are panic buying, and for some reason we planned, we in March we would have only sold 5,000 in March, but you know what, people panic buying because of circumstances right now, so we need a whole lot more in stock. You always need to have extra, just in case of whatever reason you need to provide more stock. At the same time, as I said before, you're not going to provide too much extra because you don't want to tie up your cash flow, because to make more stock means you have to put out more money, and the longer that stock is held, the longer that money is not converted to cash. So cash flow for businesses is actually a very important thing to manage. Okay, the production budget is typically presented in either a monthly or quarterly format. The basic calculation used in the production budget is, so we have the forecasted unit sales, the planned finished goods, so we add them together, we'll get the total amount of production required. We need to actually minus the finished goods inventory to get how much we are going to be manufacturing, right? So we'll see that here in the table. All right, so we have the production budget, but again, the same 3 months. So the forecasted unit sales, so the same thing from before, the 5,500, 6,000, and 7,000. We are going to add our planned ending inventory. So we are planning to have at the end of January, 500 items remaining. February 500, March 500. What we have to do is we have to add the amount we expect to have remaining to the amount we plan to sell to get how much production we are requiring. Okay, so when you add those two columns, we will get the total production required. But we have to take away what we had in the inventory from before, which means at the beginning of January, we would have had 1,000 units in stock. So if total, okay, hold on 1 second. Yes, sorry about that. My kids are rather loud today. Okay, so we have the total amount that we are requiring. But if it is we had 1,000 when we started January, it means we don't have to produce that 1,000 to get the total amount required. So we are going to minus the beginning inventory. So at the beginning of January, we had 1,000. We need to make 5,500 to sell, and we want to have 500 at the end. So to find out how much we need to manufacture, we take our forecasted unit sales, add it to the ending inventory units to get the total production required, 6,000, but we minus the opening inventory amount. So the amount of units to be manufactured is actually 5,000 units. We do the same thing for February. So we forecast that we're going to sell 6,000, and our planned ending inventory will be 500, so we add them both together to get the total production required. But then we minus how much we would have had at the beginning of February, right? So to get how much we would have had at the beginning of February, all you have to look at is your ending inventory units from January. So you see in January, we had planned ending inventory units, meaning in January month, we plan to remain with 500. So the beginning inventory for February would be that same 500, right? I'm gonna repeat that one more time. So in January month, we said at the end of January, we are planning to have 500 items remaining. So February, when we start February, we should have a beginning balance of that same 500, because if it end of January, it's obviously going to begin February. So that 500 is actually brought down there to February. And when we minus that from February, we will get the amount of units that we actually have to manufacture. March again now, we expect to sell 7,000 units. We add the planned ending. Okay, we're running out of time. All right, so we'll finish this before. Okay, so we are going to have the 7,000 we plan to sell in March. We add the ending inventory units, which is 500. We will get total production required 7,500, but the beginning inventory, how much we had at the end of February, which is 500, we minus that. So we only need to manufacture 700 units. Okay, so that's it for the production budget. So we had a question here where they ask you to do prepare sales budget for the quarter. Now, this is pretty simple, right? I want you to try it on your own. The Quick Fix Electronics produces and sells a new model of computers. The computers sell for $3,000 per unit. So one is $3,000. As a result of the intense competition of Quick Fix faces, management budget sales quarterly. The projections for the first 4 quarters in 2016 are as follows. So unit sales. So the expected sales for the quarter are given to you. The unit selling price is given to you, is 3,000. You have to find out the total. To find out the total is very simple. It will simply be your expected sale for the quarter multiplied by your unit cost, and that will give you the total. So everything is given to you. Basically, what you are doing for that 7 marks is just filling it into this table over here, right? So you're preparing a sales budget for each quarter showing the following: the unit selling price, the expected sales, and the total. Okay? So see how quickly you think you can write this up. And of course, you have to work out the year as a whole. So to get the year as a whole, you will add quarters 1, 2, 3, and 4 together, right? I'm giving you a few minutes to try to write it up on your own. And as soon as you're finished, let me know, and I will put up the answer on the screen as well. Right? This is actually a pretty easy question, but students always seem to mix it up. So that's why I want you all to try to work it on your own and see if you can come up with the answer. As I said, everything is given to you. It's just a matter of filling it into the table and labeling your table correctly. So we have 5 minutes remaining time on this meeting. So when we cut off and I log back on, I will put up the answer. So please try to complete it before. When you do it on your own, that's the only way you really understand it properly. Because when I put up the answer, then you look at it and be like, oh yeah, that's how you do it. You're really not going to remember anything from it like that, okay? So you need to try to work it out on your own.